Good afternoon. This is Martina Colombo, student of the BA in Marketing at the London School of Design and Marketing, and today I'm going to present the Budgeting and Financial Analysis report of the case of Netflix in the US. The presentation will kickstart with an assessment of the company's latest financial results, as well as an overall presentation of the strategic and business model, followed then by the financial analysis of the latest fiscal years, 2020 and 2021, together with the assessment of the outstanding and most relevant financial ratios and their interpretation. This will lead to the identification of the improvement RES as premises for the budgeting exercise for the short range and the long range. All the critical assessment and the conclusions will then be presented in the latest chapters of this presentation. Netflix is the main player in the entertainment services category, both in the domestic market, namely in the US and Canada, and on a global perspective in 190 countries. And in terms of market stock value, it is the 89th biggest public company in the US. The key strategic goal for the company is growing the streaming membership business globally within the parameters of the operating margin target, and they do so by attracting the new customers from the marketplace as well as retaining the current consumer base. This is fundamental for the brand as the business model entails a subscription based formula, which requires a fixed monthly fee. So it is the only source of revenue for the company as of now. In terms of assessment of in contents, and assets, the brand invests on original contents and third-party licensed contents, and particularly Netflix originals represent 50% of the current streaming online library available for the customer base to stream. Although the company has registered continuous growth since 2011, the most recent data show a negative pattern that started back in 2020 and hit the acme in the second quarter of 2022, with the loss of nearly 1.2 million subscribers in the domestic market due to a number of factors, mainly because of the pandemic that slowed down the production of original contents and raised the prices, but also because of the increasing competitiveness of the market with the entrance of new players as Amazon Prime Video and Disney Plus. So the financial analysis is based on a number of financial documents from the brand, specifically the 10K form referring to fiscal year 2020 and 2021. This because the company's fiscal year terminates in December, so the most recent and updated form that is available for consultation is the one from 2021. But also the company's balance sheet, income statement, cash flow, and stock information that are available on the company's website in the investor section, as well as the quarterly trends on the amount of new and retained subscribers and the related subscription fees split by geographic area. This because depending on the market and the local GDP and purchasing power of the customers, of course, the monthly fee changes. So the most important ratios that were considered for assessing the financial performance of the brand were first and foremost the liquidity ratios, and this because reasonably as a consequence of the business model of the brand, which is focused on heavy production of original content, the lack of cash and liquidity is represents one of the main pain point. So the current ratio was used to measure the company's capacity to pay its short-term liabilities within 1 year, weighing up all current assets to its current liabilities. It scored 1.25 in 2020 and 0.95 in 2021 versus the benchmark of the category that ranges between 1.5 and 3. Also, the quick ratio, which is the ability to extinguish the current liabilities with near cash, so within a period of time of 90 days, scored lower than the benchmark 1.1 in 2020 and in 2021 0.8 versus 1.5. This means basically that the availability of cash to cover up for the current liabilities is not so high, and it represents a negative signal for the investors. However, it is positively counterbalanced by the results in terms of profitability, because both the gross profit margin, which is the easiest ratio to gauge the company's profitability because it assets the ratio between costs of revenues, was extremely positive, and it also improved from 2020 to 2021. And the operating profit margin was again positive. It scored 18% in 2020 and 20% in 2021 versus the average of the S&P 500 that reached 12% in 2021. Another measure that needs to be considered when analyzing the financial performance of Netflix is the level of indebtedness, and specifically the debt to equity ratio, which assesses the ratio between the total debt of the company, so long term debt plus short term debt, and the total shareholders' equity, scored 0.97 in 2021, which is considered high. And the debt to coverage, which is total debt on operating cash flow, scored 5% versus 20% of the category as benchmark, golden standard for the category. So again, in terms of debt, there's a negative signal for the investors. In terms of critical analysis of what we have just presented, we can say that Netflix business strategy favors growth over profitability by investing heavily to gain new subscribers, which of course is in turn sustained by debt. The company's improvement areas are basically two: the liquidity issue, and it's because the investment in content production has increased steadily in the last eight years, and indebtedness level. So the company, despite the negative results of the ratios that were presented, has in actual fact been able to maintain an adequate level of debt, such as to keep its operation running. And at the same time, the debt to capital ratio has been maintained as healthy. In fact, it resulted in 0.66 versus 1 considered as negative threshold in 2021. This indicates that, again, while debt is an important source of financing for Netflix, it does not come with a significant risk of insolvency. In terms of budgeting exercise, the following assumptions were considered. So the amortization of cost of contents, and this is basically behind the reason why debt level is not so alarming for Netflix, because the production costs of the original content is amortized throughout several years. At the same time, this overexposed the company to the interest rate risks to acquire new capital, because it increases in the throughout the several fiscal years, of course, and the in reason of the long-term nature of the company's assets of this original content production, the interest rate for Netflix is even higher than the market standard. And then the loss of the high-spending subscribers in the US market, because again, the in the domestic market, the prices for the subscription monthly fee is premium compared to other geographies. So as far as the short-range budget is considered, here is presented a forecast for the income statement in the short term, so fiscal year 2022, terminating in December 2022. And we can see that the revenues are expected to grow, even though the percentage is less significant and high than the one that we analyzed in 2021 versus 2020. And this in reason of all the negative factors that were commented now. The cost of revenues is high. It increases as much as 15%, and this because of the constant investment on original content production. Marketing is then considered as reduced to a bare minimum because it's the first variable cost that can be cut by the company in emergency situations. Instead, technology and development is expected to increase, even though with a rate that is a percentage that is aligned to the previous years. And this in reason of the constant research in AI technology, as well as due to the investment in the gaming industry. Um, and the same thing basically applies to general and administrative. For the balance sheet, here the two voices that are interesting are the content assets net. So again, there's an increase in terms of the cost of the content assets and the long-term debt, which is considered to be kept stable and aligned to the previous fiscal years. For the long-range budget, so considering fiscal year 2025, the revenues are still expected to grow, and this because on one hand there will be the introduction of an advertising led tier for a new type of prospect that is price sensitive. And on the other hand, the cost of revenues is expected still to grow, but with a lower percentage because the company could invest in production in emerging countries such as South Korea and India, as they did for Squid Games, for instance. And marketing, as a consequence, could resume with an investment of 6% and a growth of 6% over the previous years. Technology and development will be kept as a growing voice, but with a lower percentage, still maintaining the focus on the AI technology improvement. For the long range budget plan, and specifically with the balance sheet in mind, here we can see that the costs of the content assets will again increase, but with a lower result. Because it needs to offset the lower increase of new subscribers, whilst the long-term debt will be kept stable. Same ratio were then used to assess the short range and long range plans. And so here, in the case of liquidity, we can see both the current ratio and the quick ratio. They will basically remain stable throughout the two plans, but the liquidity levels are expected to stay below the golden standard for the category, as this seems to be an intrinsic downside of Netflix content strategy. For the profit results, again, gross profit margin and operating profit margin will score positively. And here, specifically for the operating profit margin, the result will be around 14% for both years, so slightly lower and less positive than what happened for 2020 and 2021, but still above the golden standard of the S&P 500 companies in 2021. In terms of debt level, so the debt to equity ratio shows progressive positive results as a consequence of the recommended strategy to keep the level of total debt stable and aligned to the previous fiscal years. As the conclusions are concerned, we can recap saying that in up until 2020, the financial performance of the company was positive, and it was consistent with the stated business model focused on growth over profitability. However, the impact of the pandemic, the oversaturation of the competitive scenery, the increasing interest rate on debt affected the brand's financial performance, and it was clear with the negative result of Q2 2022 and the loss of 1.2 million subscribers in the US. So these showed also the pain points in terms of financial performance in the liquidity level and the debt level. So lack of liquidity on one hand and the relatively high indebtedness level on the other. As possible solutions in the short range and long range plan, we could consider the strategic diversification of sources of revenues, so advertisement and gaming offering, the production of contents through independent suppliers in emerging countries, and the efforts in keeping stable the total debt levels so that it could be consistent with the previous fiscal years. Thank you.